G'day legends, and welcome back to ETF Insights Australia. Today, we are not just doing a quick ETF review, we are doing a full masterclass on the most powerful wealth building concept on the Australian share market, the Dividend Snowball. Imagine a snowball rolling down a hill. At first, it's tiny, it barely picks up any extra snow, but as it rolls, its surface area grows. It starts picking up snow faster and faster until it becomes an unstoppable avalanche. That is exactly what happens when you structure an ETF portfolio correctly on the ASX. Your dividends buy more shares, those new shares pay more dividends, and suddenly your money is working harder than you are. The goal of this video is to give you the exact blueprint to build a portfolio that generates $2,000 a month or $24,000 a year in pure, passive income. And to hit that number reliably, we can't just throw money at random index funds. We need a precise mix of high-yield cash generators, steady capital growth, and stable defensive assets so your snowball doesn't melt when the market gets rough. Let's look at the math. I'm on the Australian government's Money Smart calculator. Let's say you start with $10,000 and invest $1,000 a month. If we build a portfolio that returns an average of 8% per year, which is our target blended return across the three pillars I'm about to show you, here's what happens. By year 10, the compounding really starts to kick in. By year 15, the returns you're earning start to rival the money you're putting in yourself. That is the snowball taking over. Now, before we look at the exact ETFs to buy, you need to understand why building a dividend portfolio in Australia is a structural advantage compared to almost anywhere else in the world. It all comes down to two words: franking credits. When a large company like BHP or Commonwealth Bank makes a profit, they first pay a 30% corporate tax to the ATO. Then they take whatever profit is left and distribute it to us, the shareholders, as a dividend. But here is the clever part. The ATO says, hold on, we already taxed that company's profit. It wouldn't be fair to tax the shareholder again on that exact same money. So they attach a little receipt to your dividend called a franking credit. When you do your tax return, these credits count as tax already paid on your behalf. If your personal tax rate is lower than the company's 30% corporate rate, which applies to many investors, especially retirees and those in lower brackets, the government will actually refund you the difference in cash. That is a meaningful boost to your effective yield, and it's entirely legal. The key takeaway: when you're evaluating any Aussie ETF for income, always look at the franked yield, not just the headline distribution yield. An ETF with a 4% yield and 80% franking can easily deliver the equivalent of 5.5% or more once you factor in the tax benefit. Your accountant can show you the exact numbers for your situation. This video is for educational purposes only and is not financial advice. Always do your own research or speak with a licensed financial advisor before making investment decisions. So we have our dividends, and we have our franking credits. But how do we actually structure the portfolio to reach $24,000 a year? This is the part most YouTube videos skip, and it's the most important part. The answer is a three-pillar approach. Each pillar plays a specific role, and together they create a portfolio that's built to generate income, grow over time, and hold its ground during market downturns. High Yield ETF, ZYAU. It's a cash flow generator. 40% allocation of your portfolio. Quality Growth ETF, AQLT. It's an inflation protection and capital growth. 40% allocation of your portfolio. Stable Income ETF, QPON. It's a defensive shock absorber. 20% allocation of your portfolio. At a blended yield of around 8% across these three pillars, a portfolio of roughly $300,000 fully invested puts you right at that $24,000 annual income mark. That is the target we are engineering toward. Keep that number in mind as we walk through each one. Before we deep dive into each ETF, there is one critical administrative step you must do right now if you haven't already. It is the engine of the entire snowball, turning on your DRP, your dividend reinvestment plan. Here's how it works. When you buy an ETF through your broker, the broker actually doesn't handle your dividends directly. The ETF provider uses a share registry, like Computershare or Link Market Services, to manage distributions. You need to log into that registry, find your ETF holding, and select Reinvest. This tells the fund, Do not put cash into my bank account. Instead, automatically purchase more units of this ETF on my behalf, with no brokerage fees charged. Every time a dividend is paid, your unit count increases. More units means more dividends next time. That compounding loop is the engine of the snowball, and it costs you nothing to switch on. Now let's build the portfolio pillar by pillar. First up, the high yield pillar. This is our heavy lifter for cash flow. I'm heading straight to the Global X website to pull up ZYAU, the S&P ASX 200 high dividend ETF. When you land on an ETF provider's page, don't get distracted by the charts. Scroll straight to the fund overview. The first thing I look at is the management fee. ZYAU sits at just 0.24%. That is remarkably low for a filtered smart beta fund that is actively screening which companies to include. Now go to the Distributions tab. This is where most beginners get confused. The headline trailing yield sits around 4%, but look right next to it, the franking level. A large portion of these distributions are franked, which means your actual grossed up effective yield is meaningfully higher than that 4% headline number once your tax return is done. Now look at the top holdings. ZYAU holds exactly 50 companies, currently heavy in BHP, ANZ, Westpac, and NAB. But it isn't simply buying them because they are large. The methodology filters based on forward-looking dividend estimates. It is specifically selecting companies that analysts expect to pay out strong dividends in the future, while avoiding companies showing signs they might cut their payout. That is a smarter approach than a plain market cap index. This is Pillar 1, the cash generator that feeds the snowball with raw income every quarter. High yield alone is not enough. Here's the trap a lot of beginner income investors fall into. They chase yield, their portfolio value stagnates or shrinks over time, and inflation quietly eats away their purchasing power. In 20 years, $24,000 a year won't go as far as it does today. That is why we need Pillar 2, the growth pillar. Let's head over to the BetaShares website and pull up AQLT, the Australian Quality ETF. AQLT tracks the Selective Australia Quality Select Index. Look at the benefits section. It spells out exactly what quality means in this context. High return on equity, low leverage, meaning low debt, and earning stability. In an environment where interest rates are elevated, companies with low debt loads have a structural advantage. They're not bleeding cash on interest repayments. Now go to the Performance tab. Check the most recent 12-month total return. At the time of filming, AQLT has been delivering well above average. The management fee is slightly higher at 0.35%, and the distribution yield is lower than ZYAU, sitting in the mid-3% range, but that is the trade-off. You are paying a small premium for companies with strong fundamentals, and the capital growth compensates for the lower yield. The role of this pillar is simple. As your portfolio's total value grows, your income target is protected against the rising cost of living. The snowball gets bigger, not just faster. Now for the pillar that 90% of beginner investors completely ignore, and it's the one that keeps your income strategy alive when everything else is falling. What happens to your snowball when the stock market crashes and companies start cutting dividends? Without a defensive anchor, your income dries up right when you need it most. That's where Pillar 3 comes in, the stable pillar. I'm pulling up the BetaShares Australian Bank Senior Floating Rate Bond ETF, ticker QPON. Do not let the long name put you off. This fund is purpose-built for passive income. Go straight to the Distributions tab and look at one thing: it pays monthly. If your goal is a reliable monthly salary from your investments, that distribution frequency is exactly what you want. Now look at the portfolio characteristics section. At the time of filming, the all-in yield is sitting in the 4.5 to 5% range. But what makes QPON special is that it holds floating rate bonds issued by Australia's major banks. Unlike standard fixed-rate bonds that lose capital value when interest rates rise, floating rate bonds adjust with the market. If the RBA hikes rates, the yield on QPON actually increases, paying you more cash. It works with rate rises, not against them. And if you look at the 5-year performance chart, the capital value is essentially a flat line. It doesn't collapse when the stock market panics. By allocating 20% of the portfolio to QPON, you're buying yourself a shock absorber, a steady monthly income stream that keeps flowing regardless of what's happening in equities. So there is your complete masterclass blueprint. Let's bring it all together. The Australian Dividend Snowball is 3 pillars working in sync: ZYAU generating raw franked cash flow, AQLT protecting your portfolio's purchasing power through quality capital growth, and QPON providing a steady monthly income stream that doesn't flinch when markets get ugly. A 40-40-20 split across these three gives you a blended return profile that targets the 8% annual return needed to reach $24,000 a year from a $300,000 portfolio. The Snowball takes time to build, but the mechanics are straightforward. And the structural advantages of Aussie investing, franking credits, DRP, low-cost ETFs, mean the compounding works harder here than almost anywhere else in the world. Your homework today is this: log into your share registry, Computershare or Link Market Services, find each of your ETF holdings, and make sure the DRP is switched to reinvest. That is the single most important action you can take today to start the snowball rolling. One last thing before you go, I want to hear from you. Looking at these 3 pillars, which one is your current portfolio missing the most? The yield from ZYAU, the quality growth from AQLT, or the defensive stability of QPON? Tell me in the comments below. If this deep dive was useful, a like genuinely helps the YouTube algorithm put this in front of more Aussie investors who need it. Hit subscribe for videos like this, and I'll see you in the next one.